Alrighty, folks. Welcome, welcome, welcome. This is Marzidi here. We're doing another episode or webinar in the New Trader series. Tonight's topic is the measured move. We'll talk about Fibonacci's. We'll talk about the ICT, the big ass candle, ranges, all kinds of stuff like that. Usual disclaimers: I am not a financial advisor. I'm not compensated in any way by the bullish bears. If you are a new trader and not part of the bullish bears community, I highly recommend you check out bullishbears.com. See if it's a group that you might like. We have a very active Discord group with some outstandingly good moderators. And so with that being the any rate, you are responsible for your own trades. You're welcome to copy and distribute this video so long as credit is given to the author, and that is me, Marzidi. That being said, let's move on. The biggest thing that a lot of traders, new traders, try to wrap their head around is the fact that there is some mathematics to trading. But a lot of trading is psychological. And if you're an engineering tech type like I am, this can really make your head hurt because, there are people that know how to trade purely on statistics, and that's fine. Like you could use services like Edgeful, and that'll be fine too. But part of the thing to understand is that there are computer algorithms, institutional algos as we call them, and they work by rule sets. So when the institutions themselves make a move, that is set by the traders at the institution, like today's CPI print. They set that up. But the rest of the time, most all of this is algorithmic trading, computer program running, and retail traders. Excuse me. So, algorithmic trading works based on math. Retail traders work off of historicals. What has it done in the past? What are they familiar with? And if there's one thing that everybody seems to know, this is an experienced trader, pardon me. Experienced traders learn about something called the measured move. Now, they may have a different name for it. They may call it the box or anything like that. But the point is that it's all the same concept here, and that is based on what we call a measured move. Here, we're going to start with today. And I'm actually going to hit two topics at one time. This is a big ass candle. Today is January 13th, 2026. We had the CPI report this morning at 8:30 Eastern Time, and this was the candle resulting from that report. Now, the thing that we want to look at with this, what does this candle tell us? Well, first of all, we see, of course, it was incredibly bullish, but did it go anywhere probabilistic? Well, I want to come back to this range right here. And I'm going to snap a fib here to here. Now, let me talk about why I chose these 2 points. Let me zoom in. This point was chosen because you can clearly see it took out all these highs prior to it. This low was chosen because it took out all these lows prior to it. So it defines a range from one extreme to another extreme. Now, let's go look at our big ass candle today, and I'm going to have to shrink this back down a little bit because the number is actually right. I want you to see where this candle punched. And I'm going to put my cursor on this line, horizontal line. And I want you to see that it punched the 1.236. Now, what is that? What is the 1236? Okay. So the 1236, we have, let me pull up WinWord real quick. There. Ooh, gosh, that's bright. Oh, golly. All right. Let's get our font up here so you guys can see it. I know it's bright. Fibonacci series. Now, you can Google this. It's an incredibly fascinating topic. But the Fibonacci series is made up of a series of numbers, and it's a mathematical thing, such as 1, comma 2, comma 3, comma. Now, 2 plus 3 makes 5. 3 plus 5 makes 8. 5 plus 8 makes 13. 8 plus 13 is 21. 13, 24 make 21 make 34. 55 and so on. Okay? That is called the Fibonacci series. And as you can see, it's simply the addition of the two numbers preceding. And so again, 2 plus 3 makes 5. 3 plus 5 makes 8. 5 plus 8 makes 13, and so on. And now that's part of the Fibonacci series. But then there's the other way, and that is this. 55 divided by 34. Excuse me, sorry. Backwards. 34 divided by 55. 34 divided 618. This is called the golden ratio. Now, the weird thing about this number is that this particular fraction, decimal, whatever, that ratio, let's also look at, let's do it the other way, and we'll say 21 divided by 34 equals 618. And then 13 divided by 21 equals, you're going to guess what this one is, right? Okay, 619. But as we move forward, we go from 55 to 89 to 144 to 213, 233, whatever the next number is. We see this, it becomes more and more to the decimal point. 618, 618, 618, 618, and that is called the golden ratio. Now, strangely enough, this fraction number, this decimal number, shows up in nature. It shows up in the human body. It's the darndest thing that this ratio number, 618, shows up many, many places in, it's got astrological astronomical, excuse me, astronomical significance. It shows up in astronomy. It shows up in nature, biology, all kinds of weird places that this number can be found. So this is called the golden ratio. Now, however, there are others. Let's take 21 and divide it not by 34, but by 55. We're going to skip one, and we're going to get 21 divided by 55 is 0.381. 0.382. Well, we rounded it to 0.382. Yeah, 0.382. And so that the math works out a little bit better here, I'm going to take the next series and I'm going to say 21 divided by 89. We're going to go out to the next Fibonacci number. 21 divided by 89 is 23, and you can see that's 23595, so that's 0.0236. Okay. And then if we take 21 and divide it by 144, the next number out, we would get 0.118, and so on. Okay. Now these fractions are the numbers that we're interested in: 618, 382, 263, and 118. Okay, now, so these are our Fibonacci ratios that we are. So this is the Fibonacci sequence. These are the Fibonacci ratios. Okay. Again, this stuff shows up all over the place in nature. So what I want to do, after I get rid of all these things here, here it is. Here's the top. Here's the bottom. Here is our big-ass candle today at 8:30. And I want you to notice where it went. It went to 236. Okay? It went 236. So we took the range from whatever that range is between 0 and 1, and we multiplied that range times 1.236, and that's where we come up with this number. All right? So let's go back over to our big-ass candle. You say, well, it went a lot further than that. I mean, golly gee, look how much further it went. Yeah, but it didn't close above it. And that's really my key thing here. Remember, these kind of reports overshoot things dramatically. Overshoot things dramatically. So the point being, though, is it did puncture the 236 line, but it didn't close above it. Now, what is the significance of not closing above it? Well, that therefore calls this a liquidity run. They went up there to trigger, we've talked about this before, all these stops. Remember, these people have gone short. So they have their stops right in here. And the fact that this has been, we're on a 5-minute here kind of thing. But anyway, so I'm trying to see what time it was. Okay, this was yesterday. I guess this was yesterday's high. So all these stops are sitting right here, and it slams through them, rushes them, and then what does it do? Well, it comes back down. Well, how far did it come down? What's this number right here? 0.5. Now, what you say, well, that's not a Fibonacci number. We just watched you do the math. That's not a Fibonacci number. Actually, you're right. It is not a Fibonacci number, but it is considered part of the measured move. It's not Fibonacci, but it is part of the measured move because it's half. So we do include the 0.5 when we talk about the measured move. All right? So there's something to kind of keep in mind. So I want you to realize that this range here was predictable to a great extent from this range back here yesterday. Certainly we overshot quite a bit here, but in that candle there, but that was a report, and that was a big institutional runaway candle. So if you take it in context that was a report that came out, then yeah, okay, the fact that it overshot it and ran off and way overshot it, understandable. The key is it did not close above and then continue. Well, what's that got to do with anything? Okay, so when where's my little drawing tool thingamajiggy? Where are you, drawing tool? Where is it? Where is it? Where is it? Or is it here? Yeah, here. This range right here. When we break above the high here, this area is liquidity all the way up to the 236. Now, it's not exact perfect to the science by any means. It's not an exact perfect science, but generally speaking, if we are running liquidity to grab the stops to go back the other way, you will see that it will close inside this range and then roll back down. Now, the same thing works going the other way, and let's take a look at that. Let's go over here. Now, okay, whoops, I didn't mean to do that. Go away. So let's mark off the 236. So here is the 236 zone, and here is the 128. So we're going to zoom in a little bit over here. All right, so what do we see happened here? Here's the 1236. Did it close below it? Yes. Here's the 236, or 111 or 112. Here's the 236. Did it close below it? Yes. If it closes below the 236, we expect it to move on to the 0.5. We expect it to move to the 0.5. Now, that's not to say it would chop, and that's not a trade necessarily unless the range is wide enough. We don't want to take a trade if there's no money in this trade. You say, well, if I hit profit target, I make 1 point. Well, okay, if 1 point's acceptable to you, fine. But we always need to make sure there's enough money in the trade. However, the point being is that over here, okay. So let's follow this line over this way. Here, it broke outside of the box, but it couldn't close above the 236. Therefore, it went right back down. So this is a shorting opportunity, and in fact, I traded that. When I saw that it did not break the 236, then I took it short with my stop up here. Well, if I can draw a straight line, but my stop was up there. I went short, and I took it out. I stopped, I don't know, where did I stop? 28.19, somewhere around in here maybe. I forget now. But at any rate, because it didn't close above the 236, if it closes above the 236, I think there's a good chance it can go to the 0.5. But because it didn't, I expect it to go back inside the box, which it did. Now, of course, that again, no trade wins 100% of the time. However, the key is, what I'm trying to teach you here is this trading idea of looking at this move over here was actually predicted Friday's high and pre-market low. Predicted the range. Now, obviously, when we get a report like CPI, we don't really know exactly where it's going to go. It could go up, it could go down. We don't know which direction it's going to go or anything like that. This is the reason we do not trade these kind of reports. We don't trade because we don't know what direction they're going to go. Remember, the direction that the trade goes here, this big-ass green candle, has nothing to do with the report as far as the results. It's simply that all the institutions agree on the time that they're going to have their trade, and they agree that it's going to be the time of the report. Now, one caveat, if the report comes out way out of bounds of what's expected, that's different. But so long as the report is halfway close to what people are expecting, the institutions have already set up their move. And the move was set up long before the report came out. So that's why when you see one of these things like an FOMC or PCE or FOMC or CPIs and all that kind of stuff, when those things come out, you ask yourself, why didn't the candle go in the right direction and blah, 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 blah? It's because the setup was already set in motion, was already set up before the report came out. Now, however, today we kind of see that the institutions happen to be all in agreement because the candle ran pretty strongly in one direction, right? It opened down here, very little wick down here, closed up here. That tells us that most all the institutions had planned a bullish move. Probably there were some institutions going bearish. They got run over. All right? So in this case here, vast majority of institutions were planning a bullish move, and so that's the way this played out. Okay. So we talk about this. We've talked about this measured move. Now let's talk about the big-ass candle. Now that's something. I named that. That is whatever. I'm just being silly with it, but it's still, the point is a candle that, let's talk about the characteristics of this candle. First of all, it's an engulfing candle. What does that mean? That means that the high is greater than the prior candle's high, while at the same time, the low is lower than the previous candle's low. It looks like maybe just a tick. It still counts. So if this candle, here's another engulfing candle right here. I'll move my mouse off of it so that you can see. Took out this red candle on both sides, and that's called an engulfing candle. All right, back to the big-ass candle. So what can we assess from this big-ass candle? Well, watch this. The high of that candle to the low of that candle. Price came down, back inside the box, chopped around. This is where everybody was getting tired and bored and waiting and waiting. When it broke out of the box, right here, where did it go? Let's zoom in here. Here's the 118. Signet calls it the 111 because it's just funny to say. It's technically it's the the 118, whatever. But at any rate, broke here. Here's the 236. Came down, not all in the same candle, but the question is, did it turn around and go back inside the box? No. It closed on this candle right here outside of the 236. So where do we expect it to go? At least is the dot 5. And then as we can see, look how perfect that is. Now maybe, wait a minute. Whoops, okay. So this one, right to the tick on the 618. Now the next one ran, but look how beautiful that is, the 618. Right there it is, okay? Then, let's see what happened after that. It came back inside the box. Now, inside the box, I just use standard 25 percenters. That's me. That's me. I've got 0, 25, 50, 75, 0.75. And as you can see, it came back in here around 25, and then when it went back outside the box again, where'd it go? To the 0.5. Right? Now let's see. To the 2.6. Here's the 786. And then it gave it up. That one's really, the 786 is not a very clean one. You'll see that very commonly. Not many people bother with the 786. But the 618, the dot 5, absolutely. And then it came back up. These yellow lines are what are volume pointer controls. For this discussion, you can ignore that. So, at any rate, now here we are. It is Tuesday night, and here's the opening, and so forth like that. Well, you can say, well, what about that there? That's a pretty big-ass candle. Well, let's take a look. I have not looked at it. Select the Fibonacci. Here to here. Okay. Here's the one line. It went all the way up before it turned and went all the way to the tick right there to the 0.5. Look at that. Came back inside and chopped for the rest of the night. Okay. So where do we get these measured moves? Where do they come from? Well, obviously we talked about the big ass candle. And I talked about this significant range. But does it happen other places? Well, let's go take a look. Let's go to the 1 minute. Actually, let's go this way. Here we go. I have not looked at this. I don't know. Now, I want to point out this little range right here. This high took out a bunch of highs. This low took out quite a few little lows. Let's see what happens. I don't know. I haven't looked at it. There. All right. Now, this is very interesting because, well, too much. It actually did close above the 1, 2, 3, 6, but then it gave up the ghost. It got close. It got close to the dot 5, but it just couldn't. It ran out of juice at the last second. So, okay. So this one's kind of a failed mixed bag here, but I want you to notice that at the high of this candle, look at all this. Choppity, 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 chop. What does that tell us? Can I do something with that? Going the wrong way. Hang on. Let me get things right. I'm hitting the wrong keys. All right. I'm going to take the high of this little chop zone right here, and I'm going to take the low of this little chop zone here. What do you see? Right there. To the tick. To the tick. Okay? So there is So wait a minute. You say, I'm confused. What is this? This is your classic chop zone. Yeah, okay, this is a high that took out a bunch of highs. But this low didn't take out a bunch of lows. No, this is a chop. Look, chop, 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 up, down, up, down, up, down, up, down. Well, it has formed enough candles. Notice I said that. Formed enough candles here because I don't know how many candles there are. 4, 5, 6, 7, 8, 9, 10, 12, 14, 16, 20. 19 candles before it moved. Okay? It formed enough candles to form a chop zone, an indecision. Now, why do these indecisions happen in the first place? Why do these chop zones happen? Because we had a big-ass candle. Well, what about a big-ass candle? So what? What follows a big-ass candle? Consolidation. Consolidation very commonly follows a big-ass candle. You say, wait a minute, I don't understand. Why? Well, because a lot of money was spent to make this move. A lot of money was spent by the institutions to make this move. And after this move is made, they spent all their money. And so the institutions have made their move, they're out. The only thing trading right here are the algos and the retailers. Well, neither one of them, the algos not going to spend a lot of money, and the retailers don't have a lot of money, and they're not willing to risk it, so chop, 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 chop. But when it finally moves out, now, was it an algo or a retailer here? I don't know. I don't know what pushed it out, but you saw how far it went. It went 50%. Now you say, well, how do I trade that? Well, let's look at that. By the time we get to these latter candles, what do you have? I'm afraid I'm going to have to do it this way. We've got a high. Well, I didn't want it to draw all the way over there, but at any rate, we've got a high, we've got a low. That's not showing up very clearly, but we've got a high, we've got a low. We've been chopping inside of this. So what would you think? What do you expect the candle to do if you didn't know about this red candle reversal? When you see this thing come back down here, what do you think is going to happen? You figure it's going to bounce. So if it bounces, where's it going to, to where is it going to bounce? How about the other side? Somewhere in the middle. But the point being is that this is a ping-pong range. Ping-pong, ping-pong. So you're trading the back and forths. Now you say, whoa, but you don't know if this candle here is going to break out or whatever like that. You're right, I don't. And in fact, right here is a fair value gap that looking at this, I would expect it to go down into this. We'll get to that fair value gap in a moment, but it didn't. But the point being is that you have a very, very tight stop here. Because if you think it's going to bounce somewhere right here, then your stop is just right here. Just a couple, 1 point, 2 points here for a reversal play over here. So an easy 1 to 3, risk 1 to make 3 or more, 5, I don't know, whatever. But my point being is that you can take this reversal right here on these bottoms to go long, because that's what it's been. You have a box, and you're expecting it to ping pong in the box. Why? Because we're noticing that that's what it's doing. Now, I'll be very honest. If I were taking this trade, I would have expected it to come down into here first. It didn't. So I would have missed the trade. I would have simply missed the trade. You say, well, I could take it in the, yeah, you could take it anywhere you want to, but there's no money in this trade up here to go long. Right? There's no money. And your stop is way back down here. This is when you hear me say things like, your profit is on your entry, not your exit. Because it's the same exit. It's the same exit, but where you get in dictates how much money you make on the trade. If you get in, if you're going long and you get in up here, there's no money in this trade. I mean, there's some, but there's a lot more money if you get in back here. Not to mention the fact that your stop is much closer, because the stop's going to go in the same place. It's this candle right here. It's 1 or 2, 3 wicks below this candle right here. Okay? So the stop's in the same place. The take profit's in the same place. The only thing that matters is the entry. We should be looking for that entry down here so that we can maximize the profit and minimize the loss. Now, can it go the other way? Of course it could go the other way. I mean, can we get stopped out? We could get stopped out. But the same thing occurs going long, going short. Do we have any other Fibonacci sequences in here or measured moves? How about this one? Have I done this one yet? I don't know that I've done this one yet. Let's look. $618, right here, right there. Notice the green close right above the 236 right here. Actually, it was over here. Now, it did pull back in, and that might have stopped us out, depending on where our stop is. It did pull back in, but here's the 236, here's the 118. So, yeah, I probably would have gotten, well, this is the 0 line, or the 1, whatever. If I were trading this, I would have probably taken the reversal here, and I would have probably made a small amount of money. Because once I saw this red candle, once I'd hit this 236, I'd have probably gone short, and I'd have probably, scratched or maybe made a little bit of money because I would have been expecting it to come back in a little bit deeper. However, let's look at one other thing, though. I've lost where I'm doing here. Yeah, okay. We were talking right in there. But at any rate, so there's different things we can talk about here. But however, my point being is that we did close. Oh, wait, I am wrong. It closed above the 118. Excuse me, I am totally wrong here. It rejected the 236, unless I'm in the wrong place. Were we talking over here? I've lost my place in the chart. Anyway, let's look at a fresh one. I've gotten myself all confabulated here. Confabulated. About this one. Let's see what it did. Here to here. Price broke below. Where did it go? Here's the 0.5 right here. Let's zoom in on that. Okay, look at there. There's the 0.5. Here's the 618. Not as nice and pretty looking on the 618, but it's there. Where's the full measured move? Right down here. 100%. Right there. So, there's an example of an absolute went from one point to another. So what do we know about this measured move business? We know that if it doesn't close outside of the 236, that the odds are it's coming back inside the box. On the other hand, if it does close outside the 236, it's got a very good chance of getting to the .5, maybe even the .6, but a full one-to-one measured move gets, you'll notice this is the first one we've looked at where it actually made a full measured move. So the full measured move is not as frequent. It happens, of course. So how would you trade this? We'd be watching this 236 area. And we see a close below the 236 right here. Now, because we see this close below the 236, I'm not thinking reversal, I'm thinking continuation. And so maybe I'm going to give it a little bit of moment to see if it'll chop around for a second, right in here maybe. And I would probably go, so here it is, here's the close below. I'm looking for a little bit of chop. Here's a little bit of chop. Somewhere in here, go short. Okay, my stop's got to go back here anyway. And now I'm going to be looking for at least the 50%, which happens here on this next candle, next couple candles, whatever. So that would have been a very quick trade. And then you can leave a runner. Leave one extra contract going and see how far it'll go. And you just keep moving your stops up behind it as it makes a move here. I move my stop to here. Then when it moves here, I move my stop about 2 candles behind it. And then just keep walking my stop with it until I see how far is it going to go. Then this big candle here happens. Well, my stop is back here, so I'm still in this trade. Then this happens. My stop back here. This happens. My stop is here. And I'm still in this trade until this candle. Or something like that, or somewhere around in here. Isn't that amazing? Isn't that absolutely amazing? So the measured move and the Fibonacci's. So I've taught you now about the Fibonacci numbers. So a lot of people use the Fibonacci's with their moving averages. They'll use the 3, the 10, the 3 and the 10. The 3, the 8. Some people use the 13. The 21 is very popular. 21 in a moving average, very popular. It also happens to be the number of average trading days in a month is 21. Purely coincidental. They'll use the 34, the 55. Some people like the 89s and so on. So they'll actually use those for their moving averages. And then other people will just simply use, the 20, the 50, the 100, and the 200. It doesn't matter. It's a matter of, do you know how to trade what's in front of you? You set it up. I don't care if you want to use a Fibonacci or not. Learn to trade your style. Okay. But at any rate, Fibonacci's very popular with targets like the 618s, and the 118 and the 236, very popular, very important numbers. So we've talked about that. We've talked about the big ass candle as a way to as a reference point. We've talked about let me clear that, significant high to a significant low. Now, we've talked about, well, when, over here in this chop, we were talking about, well, when do you get in? So let's talk about, I'm looking for, hang on, pardon me while I reassess my situation here. Right, there it is. Here, market open, okay. Let me get back over here. Tell you someplace else that a lot of people are interested in. Now this, what I'm going to talk about, is a trading strategy called ICT. I don't know if I can draw this or not, but we'll try it. I C T. And it's called inner circle trading. It was created by a guy named Michael Huddleston. It became extremely famous 3 years ago. Extremely famous. And it worked. It absolutely worked. And people made incredible amounts of money with it until the institutions caught on. And then they started realizing this strategy that people were using and making money against them. So they changed the way they did stuff so that people that lived and breathed by the ICT started getting their butts handed to them. Okay. The ICT strategy works like this. We start at market open. Let me see. I'm going to put a vertical line here. Let me see if I can get a vertical line here. All right, about here, which happens to be the high. Okay, so we don't need that then. Not this high. That was CPI. Now, here's the way ICT works. Like I say, it doesn't work near what it used to, and there are a lot of caveats to it nowadays. So let me explain how it works. First of all, we have to have the measured move. And that always starts at how do I say this? When Michael Huddleston created it, he said it was regular trading hours only. Okay. So I'm going to start at regular trading hours, which happened to be the high. Purely coincidental. If the high had happened later, I would start with it later. And I come down to a low. I am looking for a market structure shift. Now, a market structure shift is this big ass candle. Not, nice day, pretty day. Isn't it sunny out today? Wham! Here we are, big ass candle. That's called a market structure shift in the ICT terminology. And it creates something. It creates, a special type of a gap. And that gap, see this red candle right here? You see the bottom of its wick is right here. Okay? Then you got the big ass candle. And then this third candle, here's the top of its wick. Well, what we notice is that there is no overlap between candle 1's wick and candle 3's wick. Candle 2 is the market structure shift, aka the big ass candle in this case. But it leaves this gap. Now, this gap was what we call the fair value gap. And that was coined by Michael Huddleston when he created ICT. What this means is that this middle candle, this big ass candle, moved so fast that there were people that wanted to go short here, but they missed their chance because the candle moved so fast that their limit orders did not get filled. Now the idea here is that they still may want to go short, but they don't want to pay the price down here to go short. They wanted somewhere in here to go short and didn't get that chance because the candle moved too fast and it went and their limits didn't fill, right? So what the idea though is that they're still willing to go short, but only if price comes back into here. Okay? There is a caveat to this, though, and that is notice here's 1, here's 0.75, here's 0.5, then 0.25, and so on. Okay. The caveat is that fair value gap has to be more than halfway back. So we're looking at the 50% line here. That caveat is if this is the measured move, we've got to come back at least 50%. Here's 50% line. Then we've got to come back at least 50%. And are these people here still willing to go short? And we see that we stick a toe in. Well, we get real close or whatever. Wait, let me see if I can do this. Here's that fair value gap. And if you look, you can barely see it. I'm going to line my cursor horizontally. I'm going to line up at the bottom of that fair value gap. Look left of my cursor, and you see we stuck a toe, a wick, into that fair value gap. That triggers the ICT setup right there. That little red wick to my left of the cursor triggers the ICT setup. And it says, are you people still wanting to go short? And they said, yes. And so that is how the ICT setup works. It is the idea that we had a high, we had a low. Some people who wanted to go short didn't get a chance. Left a gap. Price came back up to that gap. These people got their second chance to go short again, and they did. That's an ICT setup. Now, it works the other way. If the low had formed first, then the high, then the pullback, the question is, are these people still wanting to go long? And they say yes. And we go the other way. Now, so you have a significant high, a significant low. During that move of that significant high to significant low, you created a fair value gap and a market structure shift, a big ass candle. And then throughout the day, eventually at some point, we come back in later in the day, back to that fair value gap to see if these people still want to go short. And if they do, we roll over. And again, it works exactly the same way going the other way. If the low had formed first, then the high, we'd look for the pull back down into that fair value gap in order to go long. All right. Now, a couple comments about the fair value, about ICT. Number one, it does not work as predictably as it did in the past. When it first came out, it was just absolutely bonkers. People were just making money hand over fist using it. It does not work as often anymore, and a lot of times you'll see that price will push into that fair value gap and just push on through it a little bit more to stop everybody out before it rolls on over. The idea is that the price is supposed to turn inside that fair value gap. And when the institutions realized that, they knew that all these people were sitting over here ready to get into an entry, and so that what they would do is they would just blast them out of the water by letting them get into the trade and then running their stops and then make the rollover. So the institutions adapted. So as you can see, though, the ICT trade still works sometimes, but not with the regularity that it used to. But it's something to be aware of when you see it. It plays out, Michael Huddleston would say it plays out on all time frames. I think I see it play out more often on the 1 minute and the 5 minute more than the others. does it play out on the dailies? Yeah, it can, certainly can, because we do say that trading's fractal, and if it's fractal, it's got to be fractal on all time frames. But I see it more commonly on the 1 minutes and the 5 minutes. So there's your ICT. Remember, folks, this is an open mic, and of course you can always chat in the forum if you're over in the Discord here. If you've got questions for me, feel free. And yes, this is being recorded and will be posted. So there is your ICT. All right. What else? Clear this. Let's see, we talked about the candle. We've talked about ranges. Is this whole measured move business work on all time frames? Absolutely. Trading's fractal. Now, would you want to do measured moves over in this little chop? I mean, yeah, you can. Is there any money in it? Probably not. I did trade right here, right before all the CPI report, but you can. All right. Let's see. Have I missed anything? This is not an ICT setup here because you don't have a significant low before you had the big ass candle in the opposite direction. This is not a change in sentiment. This was bullish, and it still is bullish. When we look over here at the ICT play, it was right here where, shoot, hang on, sorry, I've messed this up. Moved my mouse, me meese. The overall trend, although it was a bunch of highs and lows, was still bullish. Now, some of you may also look at that and say, it looks like a bear flag. And yes, it technically probably is a bear flag. Here's the pole. Here's the flag. Here's the break. Remember that many trading strategies have amazing overlap in them. Okay? There's a lot of overlap in this because not only do we have a bear flag, we have an ICT trade set up, though it took longer to play out. And as far as the ranges go, this was chop here, right? So let me see if I can, give me a moment. I think we did this already, or did we not? Fib. Here. Here. That little chop. Where did it go? All right. Anything significant here? Here's the 1.5. That first candle that slammed through this went to the 1.5. Pulled back a little bit. Yeah, I mean, nothing really exciting here. Obviously, it made a full measured move, and then what did it do upon making a full measured move? Chop, chop, chop. Why? Because now we're waiting to see who's going to make the next move. That's what chop is. Nobody's made the next move yet and threw enough money in it to make it happen. Right? Oh, let me go look at my notes. Make sure okay. The measured move. So there we've covered the measured move over and over and over ad nauseum. Does it always play out? No, of course not. What it gives us is targets. Now, your trading strategies where you get in. But now you can certainly, so we've talked about, though, when you see ranges going on, you could play some ping pong inside the ranges. We talked about ICT as a possible trade. But the thing about the ICT is you need something else to tell you to take this trade now. Not because it just went up into a fair value gap. You need something else to tell you to take this trade that is in conjunction with this ICT setup. You know, down here you can see I've got the RSI plotted, and, you know, it's definitely overbought. So you could say I'm overbought plus I got the ICT entry. Maybe so. Where does the stop go? Just on the other side of the fair value gap. Just on the other side. It's kind of wide, yeah, you know, or can be. Actually, it's only about three to 4 points, so it's not that bad. Only about 3 to 4 points. The other thing about ICT is that does not guarantee it comes back to zero anytime soon. If it rolls over, that's great. Does not mean it's going to go all the way to zero. And you have to treat the fact that if it goes back to zero and starts the measured move outside of the box as coincidence, or, you know, just a separate trade. The only thing the ICT tells you is that it's supposed to turn and reverse somewhere inside that fair value gap. That's all it tells you. How far it goes from there is based on the measured move. All right. All right, so that is the measured move, big ass candles, ICT. We've talked about it in ranges. We've talked about it in highs and lows. Are there any other places it can show up? Absolutely. There are other places. I don't see one immediately, so I'm just going to draw it out. Let's just say that you saw a Head and Shoulders. So price is coming up, and you start to see the Head and Shoulders forming, right? Well, remember, you have the left shoulder, the head, the right shoulder, and this area here is called the neck. Well, what we do is we snap a fib from the head to the neck, and there's our measured move. What is a Head and Shoulders supposed to do? Break. It's a reversal signal. Same thing in the opposite way. We are bearish. Left shoulder, head, neck, right shoulder. So here's the neckline, these 2 points here. We snap a fib here to here, and that should tell us how far, assuming that it plays out, that it will go when it breaks, because it's a reversal pattern. What does a Head and Shoulders mean? Well, a Head and Shoulders means they made a push. They ran out of money, and they got pushed back. So they threw more money at it, and they got pushed back anyway by more money. So they make a third push, but this is the exhaustion right here. That's just plain and simply it. This is the exhaustion. There's no question that the sellers have way more money that they're willing to throw at this than the buyers. So they throw in the towel and they let it go south. They get out and it goes south. Same way here. Sellers push, reject. Harder push, reject. They want that third push, but instead reject. They give up, throw in the towel. They're out of money. The buyers take it. Okay? There's a reason for all these kind of patterns. There's a reason for all these kind of patterns. Oops, that's not what I wanted. One second. Yeah, here we go. Now, as you can see, I'll go ahead and tell you this did not play out perfectly, but this is called a drop, clearly. Drop. This candle here is called the base. or a basing candle. Yeah, don't you love it? Hear my writing with the mouse? Oh, this is nerve-wracking. There you go. There's your base. That green candle is called the base candle. It is a spinning top of the opposite color. So you have your drop, your base, which is a spinning top or doji of the opposite color, rally. So it's drop, base, rally. What is the target of the rally? This candle's high. Now we fell short of it, but that's what that is. It works the other way when you have a green candle, then a red doji spinning top, followed by a red candle targeting that low over there. So it's a reversal pattern. So this one would have been green, then this would have been red, and red. Or in the opposite direction, red, green, green. So here you have your rally, base, drop. But you could also have a rally, base, rally, or a drop, base, rally, or drop, base, drop. You say, well, how are you supposed to know? You know by looking which side of the basing candle breaks first. Plain and simply. Here's the basing candle, green. On the number, so here's the drop, here's the base. Which side, this candle 3, which side did it take out of the base? Well, it took out the top. So that's a rally. If it had taken out the bottom, then it would be a drop, base, drop. And in which case, we could use possibly this candle, which happens to be a big-ass candle, but but a lot of times you'll see these, the big-ass candle, and there's your measured move right there for how far it's going down. Matter of fact, let's see what happened. Here's the big-ass candle, the drop in the base did not close, it came back inside. Full measured move, okay. I don't know. I think we're starting to talk about the same stuff over and over. All right. Enough of that. So this is where I'm done talking about Fibonacci's and measured moves and all that kind of stuff. I'm going to switch gears and talk about brokers for a moment. So I'm going to bring up my little spreadsheet here. Spreadsheet. Where are the brokers? What do I do with them? Oh, here they are. So, let's talk about, and I'll get to volume profile and stuff like that, and auction market. Everything's out of sequence here. But I'm just going to go down this part of the spreadsheet here real quick and knock out a few of these kinds of things here. A lot of people coming new into trading ask about, well, who should I set up a broker with, an account? Who should I use? So let's kind of talk a little bit about your traditional, old school brokerages. And those would be Schwab. If I can get, come on, mouse. IBKR. Fidelity. E-Trade, yeah. All right, these are your old school brokers. Now, what do I mean by old school brokers? Well, their big thing was 10, 15 years ago, they were all big stock trading companies, brokers. All big stock trading brokers because back then, that's what people traded. They traded stocks. Options were too expensive. Futures? Nobody traded futures 10, 15 years ago, probably. Only, a very select few people did, but most people traded stocks. And these are your old school brokers who still, quite frankly, specialize in that. This is Interactive Brokers, by the way. Interactive Brokers, but most people call them IBKR as well. Either one works. So let's just start at the top here. There was originally a company called TD. Actually, let me go back even further. Scottrade. Scottrade bought or licensed Thinkorswim from Tom Sosnoff. Scottrade got bought out by TD Ameritrade. Sosnoff continued to license Thinkorswim to TD Ameritrade. Now, TD Ameritrade was great, absolutely great. Thinkorswim worked fantastic, everything else like that. And then, finally, Schwab bought TD Ameritrade. And at this point, I'm not sure if Tom Sosnoff was totally out of the picture now. I think he may have sold all his rights to one of these guys or whatever. Anyway, Sosnoff was out of the picture, and he had gone on to form Tasty. Okay. So Scottrade, TD Ameritrade, and Schwab are all famous because you have to remember, back in the days of like Scottrade, the reason that we all traded stocks, because like I said, everything, options, stuff like that. And first of all, a lot of us didn't even know what the options and futures were, to be quite frank. But these are back in the days when it was like $13 to make a stock trade, regardless of the size, whether you bought one share or 5,000 shares. It was like $15. So you bought. And you said, okay, well, when you wanted to sell, that was another $15. Well, this is where E-Trade came into the picture. And E-Trade came in, and Scottrade got together. Well, they were competitors, but about the same time, both of them came in and says, we'll offer those same trades for $7 instead of $15. And so then you had your companies, though, like IBKR and Fidelity and all these others. And so this war started on, well, who can sell their stocks for the cheapest? And their commissions, I should say. And anyway, so that went on for a long, long time. Anyway, and then, of course, we got something called pay for order flow. Pay for order flow. Pay for order flow. What does that mean? Well, what that means is that your traditional brokers, when they charged you a commission, had an obligation to get you the absolute best price that they could. So, Fidelity, or E-Trade, we'll go with Schwab now anyway. But back then it was Scottrade. Scottrade charged you $7 to make a trade, and they were hooked up with several market makers who handled Apple. So you wanted to buy some Apple shares or sell some Apple shares or whatever. So they say you wanted to buy some Apple shares. Well, Scottrade was hooked up with several market makers. And so you would place your order with Scottrade, and then Scottrade had a fiduciary responsibility to look at all those market makers and say, who gives my client, me and you, the best price? He wants to buy it at $100. I need somebody that'll sell it to me for $100 because that's the best price. No, not 101, not 102, $100. Okay? Because you were paying for that. You were paying $7 for that trade. All right. Well, this war came out of everybody trying to figure out who can charge the least, and still make money being a stock trading broker. All right. Then they got this grand idea of pay for order flow. And the idea was this. Instead of charging you a commission, what if you let us, instead of getting the absolute best broker, market maker, if you can give us a little bit of slippage, maybe, You said you wanted that stock for $100, but I won't charge you a commission if you'll let me sell it to you for $100 and 3 cents. And I'll keep the 3 cents per share. I'll keep that 3 cents per share. Or it may go like this. You say flat 100. I won't pay a penny more. So they go look for a market maker that will give it to them for $99.97. And they will give it to you for 100. But they got it for $99.97 and they keep the 3 cents. And that's called pay for order flow. So the brokers are still making money. They're still making money, but you're not paying the commission anymore. Okay? And so that's called pay for order flow. All right. Enter options and all that other kind of stuff. Robinhood. Tasty Trade. I'm sure there's others. Now, these guys came in as the discount broker, and if you were back in the day, you remember Robinhood was like, oh man, they are, there's nothing, they don't charge you anything to trade on them, blah, 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 blah. And Tasty came in with, all that kind of stuff as well, and that was all because of pay for order flow, which means that your broker is getting a better price than you are. They're getting a better price than you are, and you're not getting that because they're keeping that spread. You said you would pay $100. They found it for $99.70. They charged you $100. They kept 30 cents. That's called pay for order flow. But they kept their word. You said you'd pay $100, so okay. Everybody's even. Everybody's even. No foul play here. And they didn't charge you a commission. Well, then Robinhood comes along and they start getting into options and trade it. Well, actually, and Tasty was big into options. So these guys were all about options and stocks. Okay? And so then the options trading wars started. Robinhood led the way because they were saying that they would not charge anybody for options, and I don't think they charge much, hardly at all today, but their pay for order flow is more strict, or what am I trying to say? In other words, they have a lot more slippage at Robinhood than you do on Tasty, which means if you're absolutely firm that you must get this price in an options when you try to close it, you may sit there for 20 minutes trying to close that option because let's say you're trying to close the option again. Let's say you went long in an option in a call and you got in at $1. You want to get out at $1.50. Robinhood wants it at $1.55. Now they're going to give you $1.50, but they're going to keep that 5 cents, right? Well, what if they can't get it at $1.55? Now you're looking at the board and it shows that it's at $1.51, but it won't close. Why won't it close? You wanted $1.50, it's $1.51. Why won't it close? Because Robinhood wants $1.55. The 5 cent commission for them that they're not charging you, but they still got to make money. And that's why the order sits there, and you're like, why won't it close? And eventually, hopefully it will, and all that kind of stuff. Tasty, on the other hand, Tasty and all these guys back up here all started off charging just a commission for options trading. Thinkorswim, IBKR, Fidelity, and E-Trade start around 60 cents each way per contract, per leg. But Robinhood does not charge you but a couple pennies because they're using pay for order flow. And Tasty, however, has got a completely different thing. They charge you $1 to open a trade, nothing to close the option trade. So essentially it's 50 cents round trip if you open and close it. Which is a bit of a discount over these guys over here, up here. But Tasty's got another thing, though, that if you're trading equities anyway, equity options, Tesla, Amazon, Apple, they don't charge you after the 10th contract. So if you, as far as your commissions go, if you get 10 call options on Tesla and you get or 20 call options on Tesla, the commission part is the same because they don't charge any more for 11 and after. Anyway, so that's kind of cool. All right. Then we had Kraken and Coinbase come in for crypto. Now, crypto is a little bit different because they charge a fee that, number one, depends on the number of transactions per month you make. If you make a lot of transactions every month, they give you a reduced fee. Okay, that's cool. And then part two is maker versus the taker. What does that mean? Well, maker is a limit order. That's all that means. Maker means you put in a limit order. If it reaches this value, you may trigger my trade. But if it doesn't reach it, okay, never mind. All right? So let's say that you bought some Solana. I have no idea what Solana is trading at right now, so I'm just going to say $200. But let's say you see Solana is going long. I mean, bullish, and you think Solana is going to go to, what did I say, 200? Let's say you want to get 10% anyway. You think it's going to go to 220. So you bought it at 200, and you set a limit sell order at 220. If it gets to 220, and your order's just sitting there, days maybe, hours to days to weeks, it's just sitting on the books. And if it ever gets to 220, bam, your order hits, and you sold your Solana for 220, making 10%. Okay, that's called being a maker. A taker is a market order. So a taker is just somebody that says, market, buy it right now, whatever price. Sell it right now, whatever price. Give me the chart says it's 215. Sell it, and you sell it right there for 215, and that's meaning that you didn't give the chance to the markets to balance and to work this out and stuff. You said, do it right now. Get me the closest price to that you can right now. That's called a taker. Remember that stops are market orders. They sit on the book, but they're not a limit order. They are a market order waiting to be triggered. So a stop is a taker. And so what you'll see here with Kraken and Coinbase is that they will give you a different rate depending on if you were a maker or taker for that trade. For that trade, did you put a limit order in and just sit back and wait? if price comes down to 199.80, I will be glad to take 500 shares of Solana. Fine. It may take 15 seconds to 15 days to 15 years. If it gets down there, you're a maker. You get a cheaper rate because you were willing to put liquidity into the market by saying, I'll take that if it gets here. Not until it gets here, but if it gets here, I'll take it. And you announced this to the market, and that's called a maker. But if you mark it in and you mark it out, then you are a taker and you get charged a higher commission. Bear in mind that Kraken, Coinbase, and all these other places like that, their rates are completely different. There's no standardization necessarily. Just because Kraken may charge you 6 cents a transaction does not mean that Coinbase is going to charge. Coinbase may charge you more. They may charge you less. Each crypto dealer is different. Also, crypto dealers do not necessarily have the exact same at that moment price for the same crypto. If Solana is 200 at Kraken, it might be 215 cents at Coinbase. Because they pull from different places and so forth. It's all on the chain. It's all on their respective blockchains for their cryptos and stuff. But a lot of times they're using their own in-house crypto to work with you versus having to go outside and get it. So you just have to be aware that there can be some differentiation in the prices. Now, futures came out, and futures are expensive to trade. As we talked about earlier in the What to Trade videos, we talked about the fact that the ES is $20,000 to $30,000 on Thinkorswim, Schwab, that you got to have like $30,000 in your account to trade the ES on Schwab, but on Tradeovate, you need $500. Okay? Tradeovate was purchased by NinjaTrader. There are two pieces of software now. One's called Tradeovate, which most of us know if you trade any futures at all, and the other piece of software is called NinjaTrader version 8 or NinjaTrader 8. They both point to the same place. They both do the same thing. It's just that the Tradeovate software is very simplistic, and the NinjaTrader is more professional looking. But aside from the platform software, everything behind the scenes is the same. Tradier is a new kid on the block. They do some stocks. They do options. They do futures, but it's a little bit different in that you have to have a separate account, which reminds me of TradeStation. So Tradier and TradeStation. TradeStation's been around for a while. I don't know if the TradeStations is as old as Fidelity and all these others here, but they've been around for a while. But Tradier's relatively new at the time of this recording. The difference here, though, with Tradier and TradeStation specifically is that you have to set up a completely different account to trade futures. So you have one account is for stocks and options, and the second account is for futures. Tradier, new kid on the block. Essentially, the idea is you pay them a monthly fee. They are pay for order flow. But they do charge a small fee with the idea that they're going to I guess they think they're kind of going to give you a decent price. I don't know that much about them. They do have a monthly fee that you can pay if you want to not have a per trade. So if you're trading a lot of options and you don't want to pay commissions on options, you can pay, I think it's $30 a month. I could be wrong on that number, but I think it's $30 a month. You pay Tradier, and they'll waive all your commissions on your options. They are still going to go through the pay per order flow out thing. It's just a question of how much they're going to want in the spread. You know, Robinhood wants a lot in the spread versus Schwab doesn't want as much in the spread. So you can get the same option here if you're comparing Schwab versus Robinhood. You say, well, Schwab is going to charge me 60 cents each way. That's $1.20 if I open and close it in the same day or whenever, you know. Robinhood says they won't charge me anything at all. But you may not get filled on the Robinhood order. That's the problem. You may not get filled on the Robinhood order. So you've got a discount with uncertainty for a lot more certainty for a premium price. So anyway, but Tradier, ironically, I'm in North Carolina. Tradier is out of Charlotte, North Carolina. So I've been kind of tossing back and forth in my mind what I'd want to do something with them. I haven't decided yet. But at any rate, like I said, new kid on the block, kind of interesting. TradeStation's been around for a while. They've got their own software. It's very professional software, a little bit more modern looking than like Thinkorswim, and you can get really technical with it. So, lastly, let's talk about pay for what you get. Now, look, a lot of us use Trade-of-8. I use Trade-of-8. All right? I do the bulk of my futures trading on Trade-of-8. However, they got the great discounts and stuff. I have a lifetime membership. I paid to get a lifetime membership with them and everything like that. But there's one thing that I know. You can never, ever get help on the phone or in the chat. You can't. For days, sometimes. Days. Now, if you have a problem with a trade or something like that, you need to go to the trade desk. That would be different. But if you need tech support or you've got an after-the-fact issue or something like that with a bad trade or something like that, forget it. It could take days to weeks to get somebody to address, well, hours to days, I should say, hours to days to get somebody to respond to you or to pick up the phone or whatever. I'm not joking. There's a reason they can offer the discount because they ain't got any staff. They got, obviously they have some staff, but they don't have a lot of staff in tech support. They just don't. Therefore, there's nobody to answer your email. There's nobody to answer the phone. I mean, the email will get answered eventually. Yes, of course it will. But anyway, because they are a discount broker. Now, as long as you understand this, it's fine. Perfectly fine. On the other hand, you're saying, well, Schwab, they're kind of an expensive broker, but I can have a Schwab tech support person on the phone within 3 minutes after the phone starts ringing. 2 minutes, 1 minute. I will have someone on the phone with Schwab or with Tasty on the phone and I don't have any experience with IBKR, Fidelity, E-Trade, Tradier. I will tell you, TradeStation, lickety split on the phone. You pay for it. You absolutely do. They're one of the more, they're kind of like one of this group. If I can get them over here, I'm going to put them over here. They're kind of in this group here. You pay for it. But you call them with a problem, there's somebody on the phone. Try getting somebody on the phone at Robinhood. My God, I have been locked out of my Coinbase account for over a year. I gave up on it. I only had about $100 in it. But I've been locked out. It's just gone. My password doesn't work. The reset password doesn't work. I can't find a phone number. I can't find a phone number to call. I've emailed them. Nothing. I've been locked out of my Coinbase account for over a year. So, you get what you pay for. You pay for a lot of times. So, keep that in mind. You got to keep that in mind. So, all righty. With that being said, do I want to get into this? Wah. No, I'm not. I'm not going to drag this out any further. We've gone for an hour and a half. So I am going to wind it down there. Let's take a very, very quick look and do a what do you see in this chart. I'm going to switch. I have not looked at this chart at all. I do not know what this chart says. I'm going to go to crude oil. CL1. Bang. I have not seen this chart. So we're going to go to the 5-minute. No, excuse me. We're going to start on the 30-minute. Huh. I'll be daggone. Crude oil is going up. Last time I looked at crude oil, it was, well, anyway, going down. All right, let's take a look at what we have here. We turn this off, this off, this off, and that. What do you see? There's no right or wrong here. It's a question of what do your eyes lock on to. So here's what I'm going to do. I'm going to start marking it up. You may see some of the same things I do. I don't know. Here. Maybe. 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 Go a little bit further back. Nothing permanent here yet till I... What does this do? Go left. Aha. Look at that. 4 points. That's a good trend line. Let's get rid of this one. Let's try the derived trend line. Sometimes this works, sometimes it doesn't. Clickety. Copy, paste. Sometimes it works, sometimes it doesn't. But it's derived, meaning it's not, I'm not hitting wicks and stuff. It's kind of in the area here. Here. Yep, that's a good derived. I'm going to change this to that. Notice it's the same slope, it's the same angle, but it's not wicky, not touching wicks after wicks and stuff like that. It's kind of in the area kind of a line. Okay, so there's one. There's one possible one. What else do we see? A high and a low. What happened? Where are we? Okay, here's where we broke outside of the box. We got up to the 111, came back in, hit that trend line, started walking that trend line, and we have done, you don't see that very often, but there it is, the 786. 786 is where we are now. Let's see what happened around the 50 and the 618. Broke the 50, went up, came back down to the 50, to the trend line, back to the 50, 50, 50, 50, or is that the 618? Excuse me, 618. Notice how it's chopping on that 618. And the trend line. This is interesting. What am I thinking here? I'm thinking, if I were trading crude, it's hitting that trend line. What has it done traditionally? It keeps hitting this trend line and going down. It's got a little play because this is an area. It's not a to the tick kind of thing like the solid line one. Could I see doing a long here? Yeah. I could see going long here. Stop would be not this candle. This candle's ridiculous. Stop would have to maybe be on this candle here. Why do I say this candle is ridiculous? Well, I mean, what happened is this candle opened up here and flashed way down there. Well, look how exaggerated that wick is. That wick, that may be in a news event or something. Probably some kind of a news, and it was such a flash. I don't know that I consider that. When you see wicks that are just that ridiculous compared to the rest of the body of the candle, then you just kind of have to discount it. This is a long wick, but this is also a big body candle. Look how small the body of this candle is. So I got a hard time with that wick. Excuse me. Get a little something to drink there. So I could see going long, and my stop would probably be under this candle right here, maybe about, CL trades in tenths, so I'd probably give it maybe as much as whatever that low is there, minus 0.5. Something like that. That's a possibility. Where's my upside target? We've hit this 786, so it would have to be 61.93. Now you say, where should I go to 61.93? Now this is not a trade recommendation. Don't copy my trade. Actually, I'm not taking the trade, but anytime that I see these kind of things here, I always set 1 or 2 ticks below, because so many times I've seen it come up, get really close, and then just fade right away. So I don't want to set it, if I were going long here, I wouldn't set it at 61.93. I'd set it at 61.91 or 61.92, not 61.93 necessarily, if you want a greater chance of getting your take profit hit. But again, I'm not telling anybody to take this trade. I'm just saying if I were going to take a trade right now, and this would take a full day. You'd have to sit through this entire trade. Notice this trade may take an entire day to get there. All right. Because here is the end of the day. Well, okay, according to this, maybe sometime tomorrow morning. Early afternoon, if it continues to walk the trend line. So there you go. So that's what I see in crude. Let's go to another one. Tesla. Let's go to the 15 on Tesla so we have some more candles to work with. I don't trade Tesla, so I couldn't tell you that much about it, but I want you to notice something. Yep, there it is. All right, go back to being solid. Yeah, solid. Tick, went through these. So there's your nice trend. Obviously, we're not near that trend line anymore, but that was there. Do we have a shorter term trend line? However, if Tesla turns around and starts going south, I guarantee you this trend line will come back into play. Just about guarantee. Something else. What else do I see? Do you see this little gravity well right here? For lack of a better word, I'm going to call it a gravity well. I don't know if that's a good word for it or not, but I see all this price chopping right here. We went up into it. Reject. So what do we see? If it continues going bullish, this is where it's going. Let me change the color. Y'all may not be able to see that too well. I forgot how to do this. Hang on. Indicator template. Come here. You. Well, dang it. Tell you what, I'll just double click it. Why won't you let me change the color? I want something happy. Okay, I guess you guys can see that. All right, so we see right here, we got this green zone right here. If I go left, you can see it was a hot area here, here, here. What is this? Rally base? Well, it's the wrong color. But okay, I would expect in a rally based drop that would be red spinning top, but we're going to have to count it because of where it is. It's in that same hot zone. It's kind of like Kevin's supply and demand, right? So here we go. So that's what I see there. Now let's go into the last 2 days and let's see what I see. I'm going to open this up like this. Like this. Last 2 days. Here, 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 here. Copy, paste. There. I like that. Sorta, kinda. This is derived. Notice here, here, here. I don't think it's going to touch anything in the past. Let's see how far back I can go. And look at that. There, there, there. Trend lines. There you go, folks. Trend lines. We've talked about this. How many times we talk about this? And you think, oh, that's just silly stuff. There is you a channel. A nice channel. Oh, I'm sorry. I didn't realize you said something to me earlier here. The 78.6 is considered an imposter level, meaning when price gets to this level, it has a high likelihood of acting like a reversal level. Yeah, I mean, a lot of it has to do with the probabilities go down the further away as you start to break away. I mean, in other words, it's easy to hit the 236, a little bit harder to hit the 5, a little bit harder to hit the 618. The 786 is just not very popular. I know Jeremy likes it. A lot of people will say that if they can't make it to the full 100% measured move, they'll turn on the 786. So some people will mark the 786. I know a lot of people that don't. It's totally up to you how you want to mark up your chart. But you got to remember that in order to move stock, somebody's spending money. Somebody is spending money. Somebody's making money. You know, there's a buyer, there's a seller. But the buyer is putting money to work, and at some point they run out of money. And especially if they run into resistance, you know, they're trying to go long and people keep shorting them. Well, they have to keep spending more money to keep going. You know, it becomes harder and harder for them to go long when they meet resistance. And so for a lot of cases, the 786 is that just throw in the towel kind of level. They realize they're because that's almost 25% more they got to go, right? 75 to 100 kind of thing. They're pretty close. And they're like, if we can't do it here, I'm not spending the money. So good point about the imposter level. All right. So here we are looking at Tesla. what do I see? I see a big ass candle. Let's take a look at that big ass candle, shall we? Oh, we'll snap a fib on that bad boy. Right there to right there. And where did it go to? Look at that, 1.5. Yeah, maybe a tick away from it. Right there, 1.5. That's why I always say put your targets actually just a little bit inside of your target, because if you'd been sitting on the 1.5 exactly, you might have, I don't think you would have been filled. But if you'd been one or two, a couple pennies inside here, you would have been filled, very likely. But look at there, 1.5. Ain't that something else? And it went right to it, daggone. Now, wait a minute, though. Wait a minute. Wait a minute. Hold on. Hold on there now. I see something. I don't know if you see it, but I see it. And I'm going to mark it out. Well, let's not do it on this one. We have talked about fractalized trading, and right there, watch it. Watch it. I'm going to do it again. Actually, I don't know where this is going to go. Right there to right there. And now I got to change the color of this one. Oops. Use one color. I'll change it to yeller. Y'all like yeller? Yeller's good color. No, can't use yeller. It's too close to that other color. Let's go with purple. All right, no, that's too dark. Y'all won't be able to see that. We'll go with this. Whatever. This is going to be really chaotic here for a moment. What did I do? I marked this little pullback right here, and it's in the blue. And what do you have right here? A full measured move, clearly, but we blew past it. Where, let's see, what happened? I know this is real busy here. Here's the 1, 2, 3, 6 in blue. Here. Closed on the line. Right there. Right there it is. Closed on the 1, 2, 3, 6. Off it went. Coincidence, but anyway. All right. Let's get rid of that. Let's get rid of that. Fractal. Trading is fractal. Showed you earlier that yesterday's price action and earlier today's pre-market low showed us the range of the CPI report to a certain degree. So there you go. What about this? Oh, do you see it? Do you see it? Left shoulder, right shoulder, or head. Here. Let's snap a fib from here to here. And let's change the colors back to something you can recognize or that you can see. Point to 5 right there. Look at that. Looky, looky, looky. Stall, 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 stall on the 1.5. Oh, there you go. Now there's yours. 786. Imposter, you traitor. You traitor, you. Back down. And took off again. Look at that. Look at that. Head and shoulders. Well, actually, it's called an inverse head and shoulders. It's actually not a technical, proper inverse head and shoulders because we should have actually been, you're supposed to be, come here, pencil thingy, bearish coming into it. Now, we were bearish, but this looks more like a cup and handle. and then it's sideways chop. But it was it was an inverse head and shoulders, and it won't that. It was an inverse head and shoulders, or it could be a Mr. Potato Head, depending on how you look at it. You know, you got two eyes and a nose. You know, whatever. I don't know. We can give it some angry eyebrows right there. Maybe give him a little goatee right there. He looks just like an IT tech guy, right? I'm an IT tech. I was an IT tech guy. You know, angry with a goatee, right? Except I don't have a goatee. Anyway. Okay. There's a discussion about brokers and all that kind of stuff. And I got to wind it down here because I got game night. It's game night for me at 9 o'clock. So I got 4 minutes to go get drinks and stuff like that. With that, this is Marziti signing off here. Hope you guys enjoyed it. Again, if you're new to the first time seeing my videos here, I am a member of the Bullish Bears group, bullishbears.com. Feel free to come check us out. Great group. I am not a moderator or owner or anything like that. I'm just a member that likes to make content for the group. I hope you guys get something out of it. And with that, I'm signing this bad boy off. If you have any questions or comments or anything like that, of course, you can leave it in YouTube, or you can, though, I hope if you're a Bullish Bears member, please DM me, because I don't always see this stuff in YouTube. But anyway, with that, hope you guys got something out of it. This is Marziti signing out. Be good, and if you can't, at least be good at it. Good night. Bye-bye.